How much life insurance do you actually need? Most people guess, panic, or just take whatever their job hands them. Then they either pay way too much or leave their family dangerously exposed. Today, you'll know the real number. Let's be blunt about it. Life insurance isn't about you. You'll never see a single dollar of it. It exists to catch the people who depend on you, so your death doesn't financially wreck the ones you love most. Picture it. You're gone tomorrow. The mortgage still shows up. The kids still need food, clothes, and college. Your paycheck just vanished forever. Who pays for all of it now? That's the whole point of this. First question. Does anyone actually rely on your income? If you're single, no kids, no shared debt, and nobody leans on your paycheck, you might need very little life insurance, or honestly, none at all. But now for who genuinely needs it. Anyone with dependents. Kids at home, a spouse who counts on your salary, a co-signed mortgage, aging parents you help support, a business partner tied to your shared loans. If your death would leave someone scrambling to pay bills, replace your income, or keep the house, you need coverage. The more people who depend on you, the bigger that number is going to be. Now the big question. How much? Let's start simple. The classic rule of thumb is roughly 10 to 12 times your annual income. Earn $50,000 a year? That points you toward $500,000 to $600,000. This income multiple rule is fast and easy, and it's a decent starting point. But it's rough. It ignores your actual debts, your savings, and how many years your family would genuinely need that money to last. So let's get precise with the DIME method. DIME stands for debt, income, mortgage, and education. You add up 4 real numbers, then subtract what you already have. This gives you a number built on your life. D is for debt. Add up everything you owe except the mortgage, credit cards, car loans, student loans, personal loans. When you're gone, you don't want that debt landing on the people you left behind. I is for income. Decide how many years your family needs your paycheck replaced. Then multiply. Say they need 10 years at $50,000. That's $500,000 just to keep their normal life running. M is for mortgage. Add the full payoff balance on your home. Imagine your family keeping the house completely paid off, no monthly payment hanging over them. That single move removes one of life's biggest financial fears. E is for education. Estimate what it'll cost to put your kids through school someday. College is brutally expensive and only climbing. Building it into your number means their future doesn't die along with your paycheck. Now total all 4. Debt plus income replacement plus mortgage plus education. Then subtract what you already have. Your current savings, investments, and any life insurance you already own. What's left is your real coverage gap. There's a third way too, the needs-based approach. It's basically DIME with extra detail. You total up absolutely everything your family would truly need and then subtract the assets they could already lean on without you there. Add up final expenses, like a funeral, which can run over $10,000 as an example. Add mortgage and debt payoff. Add years of income replacement. Add childcare. Add college. That total is the real picture. Then subtract what's already available. Savings, investments, retirement accounts, existing policies. Whatever gap remains is exactly how much coverage you should buy. No guessing, no round numbers, just your family's actual financial reality on paper. Now the choice that confuses everyone. Term versus whole life. Get this wrong and you'll overpay for decades. Get it right and you protect your family for pennies. Let's clear it up fast and simple. Term life is simple and cheap. You're covered for a set period, like 20 or 30 years. If you die during that window, your family gets the payout. If you outlive it, the policy just ends. That's it. Whole life or permanent insurance never expires and builds a cash value inside it. Sounds great, right? The catch is it costs dramatically more, often 5 to 15 times the price for the same death benefit. For most people, term wins easily. It gives you the most protection per dollar, exactly when your family needs it most. Whole life fits specific estate planning or lifelong dependent situations, not the average person buying pure protection. Now, the smart move. Match your term length to how long you'll actually be needed. Think about it. When will the mortgage be paid off? When will your kids be grown and standing on their own? If your youngest is 2 and you want coverage until they finish college, a 20-year or even 30-year term lines up perfectly. You're covered through the exact years your family can't survive losing your income. Once the kids are launched, the house is paid off, and your retirement savings can carry your spouse. The need shrinks. That's why renting protection through term instead of owning it forever makes so much sense. Now let's kill the 2 big mistakes that quietly destroy families. Mistake number 1, leaning only on the life insurance from your job. It feels free and easy, but it's really a trap hiding in plain sight. Employer coverage is usually tiny, often just 1 or 2 times your salary. That barely dents a mortgage. Worse, it vanishes the second you leave the job, get laid off, and your protection walks out the door too. Mistake 2. Waiting. People say they'll buy a policy later, when life calms down, but premiums are based on your age and health. Every year you wait, you get older, and that coverage gets more expensive. The proof is in the numbers. A healthy 30-year-old can often lock in a 20-year $500,000 term policy for around $20 to $30 a month as an example. Wait until 50 and that price explodes. So how do you put all this to work? Let's make it real. This week, run one of the methods. Dime is your best bet. Grab your debts, income, mortgage, and education costs and add them up. Subtract your savings and any current coverage. That number is your target. Then pick a term length that matches your youngest child reaching independence or your mortgage hitting zero. Now you've got an actual plan, not a guess. Next, get quotes. Shop term life from a few reputable insurers or use an independent broker who compares them for you. Buy your own policy, separate from work, so it follows you no matter where you go. Be honest on the application about your health and habits. Lying can void the whole policy when your family needs it most, and buy now while you're younger and healthier, because that locks in the lowest rate. One more important thing. Your number isn't permanent. Life changes, and your coverage should change too. Review it after every major milestone, because the protection that fit you last year might leave a dangerous gap this year. Got married? Bought a house? Had a baby? Got a big raise? Each one raises the stakes and usually raises the coverage you need. Set a simple reminder to check your policy every couple of years. And now, the permission you might need. You don't have to be rich or financially perfect to do this. Buying life insurance is one of the most loving, responsible moves you can make for the people you love. It's not about expecting the worst. It's about refusing to leave your family's future to chance. A small monthly payment today can mean they keep their home, their stability, and their dreams, even if you're gone. Okay, let's lock it all in. You need life insurance if people depend on your income. Use Dime to find your real number. Add up debt, income, mortgage, and education, then subtract your existing savings and current coverage. Choose term over whole life for the most protection per dollar. Match the length to your family's needs. Don't rely on work coverage and don't wait. Buy your own policy now and review it after big life events. So tell me in the comments, what's stopping you from getting covered today? I read everyone. If this helped you, give it a like, subscribe for one simple money lesson at a time, and share it with someone you love.